So let me start by thanking my colleagues for inviting me. Platts is another division of McGraw-Hill Financial. In our side, we fit into the commodities part of the business. McGraw-Hill Financial talks about being capital markets and commodities. Platts itself, and I'm not sure how many of you would be familiar with the company, Warren Platt started Platts in 1909, reporting on oil prices. He was doing that at the time of Rockefeller Oil, the Standard Oil monopoly in the US, was part of creating a market as opposed to, a situation where oil sales were dominated by a very private control by the monopoly institution. So, what's oil and gas prices got to do with project finance? I'm very, very pleased, of course, that my colleagues have already talked about how much power, gas, oil, and I'm going to say renewables as well, but I'm not going to talk about renewables. We've not yet found how to put a price on the sun. I would say as well, with it, as being an experienced professional, I'm not really certain that the governments have found out how to put a price on carbon either. But that's maybe a different story. And apologies for the cold, but I'm kind of hopefully getting over it. We introduced new branding, new slides only this last week. So it's the first time I've used these. I've got to find out what they look like in this room as well. So, and this I know was in the agenda, project finance, risk management in the raw, commodity price risk inputs and outputs. It's different this time, isn't it? And I'm not going to say a lot, but actually my words are risk management in the raw. I wanted to actually say risk management naked, stripped down to the bare bones. None of the corporate clutter that goes on, the ability to go off and have an adventure in another area, and all of the difficulties of assessing the corporates. With project finance, we know what the entity is allowed to do and what it's not going to do, so we can focus on 8, 9, 10, 12, so many different risk areas and make sure each one's managed. And in my time, I've been with a sponsor of a number of project finance entities. More recently, I've been an analyst and an approver of corporate risk to project finance entities as well. But it's already been very well covered, so that's all the raw bit is about it. We've already talked about this, obviously. 60%, I'll take 60%. That's probably relevant and worth you all paying a little bit of attention. And as I've said on the left-hand side here, does this point? I have no idea where this points. It doesn't. Okay, no problem. So, as I'm saying there, changes in energy market prices have resulted in significant number of project failures. So really what I'm going to talk about is the commodity prices over a period. I chose 20 years, 1995-2015, not because that 20 years is significant in the commodity markets, but because 20 years is a probably fairly normal period for a project. Certainly an independent power project or oil refinery, petrochemicals plant, those things that have got exposure to oil, it's very, very frequently that you're saying, so I've got a 15-year operating period, I've got 2-3 year construction period. Before you know it, you're concerned about a 20-year period. And on this chart, I've got dated Brent, and I've got West Texas Intermediate Cushing prices. And I guess everybody should be very, very aware that oil prices have fallen recently. And probably everybody's aware that in 2008 they peaked rather a lot. The first thing I wanted to show over this pattern is that until we get into the 2000s, $20 oil was a high oil price. $20 was a high oil price. If you pick up any paper today, they're wondering when the oil price is going to recover from the low $50. But if you're involved in a project, you've got 20 years, actually the high prices, the over $100 oil is very much the exception. Now I've got to qualify that by, we're talking obviously money of the day, we're not talking of inflation adjusted. I think you can go back in history and find that even the $147 is not as high as one of the inflation adjusted numbers from earlier on, but doesn't matter about that. So the first part of this chart, we've got a period where the oil prices are rising. We get up to about $60 a little bit before the financial crisis. Coming into 2008, we crossed $60 again at the beginning of the year, $147 in July, and end of the year about $35. And the ending of the year, of course, is because actually for 4 months, let's say 4 months, September, October, November, December, everything came to an end. We stopped. In the oil market, the oil tankers stopped delivering oil everywhere. There were a lot of tankers, there was nowhere for the oil to go, there were no consumers. The reason why they stopped is because the banks stopped financing it. The banks were in an existential mode, they had to survive. Very, very dramatic fall. But it's a big, big exception. You can take your view as to whether it's quantitative easing that's the result of all of the recovery, whether it's actually in fact that the world does still need oil, to keep the whole economies going. But we get back to a period where, give or take, $100 for 3 years. And then I'm going to talk about two interesting things in there, because you should pay attention to this. One of the ones is, the first part of this chart, you see a grey line and a red line, and they're virtually tied together all the way, in step, and so on. But on the last third of the chart, you see the TI and Brent diverging enormously. And that issue about the oil markets is that if you've got limitations and restrictions, then the market price is set within those limitations and restrictions. And the limitation and restriction there is that the US does not allow their oil producers to export crude oil. So TI got trapped into an oversupplied market. Now, I should qualify, they can export refined products, but if your refineries are full, your crude oil is trapped in, and so on. So you get a divergence between Brent and TI. That matters if you're using one index or another index to track what you're doing, what your project is about, and as we'll talk about in a bit, how the crude oil prices are still very dominant in the pricing of gas. And the pricing of gas has a big impact on the pricing of power. So they're tied together. It digresses a little bit away from project finance, but I remember American Airlines talking about the fact that they thought they were hedged using TI, and they realized that actually TI had detached from Brent, and the refined products, because they burn jet, they don't burn crude. the refined products in a global market were still tracking the Brent. And so if you look at American Airlines' annual report, they talk about the fact that their hedge was no longer a hedge. It can happen to your projects as well. The other thing that's going on in that period with high oil prices is people are saying, it's quite valuable if I can produce more crude oil than I would have done at $20, $40, $60. So what we get is the US oil and gas companies saying, I know how to frack. I've been doing it for natural gas for a few years, and I can digress into natural gas in a second as well. But maybe I can do it at $100 oil. Maybe it's worth seeing whether I can frack and recover sufficient oil to be economic. And of course, we all know that they did, and they did it wonderfully well. And they did it so well that the US became almost self-sufficient in its own crude oil production. Again, there's a matter of detail that can impact there, and that is the quality and the specifications of the different crude oils. Refineries are built to handle a certain type of crude, and it takes time to convert to refine different specifications. But the general thing is the US was producing a lot more crude oil than it used to do. It was no longer dependent on importing from large parts of the world. It's no longer dependent on OPEC, which has a big political impact. A lot of people will be, have read in the press again that OPEC and the Saudis, particularly November last year, chose to go to war against the US frackers. Commercial war, of course, that is. I'm not sure if that's the case. I don't think OPEC had any other choice. If they want to keep the price at $80, $90, $100 by cutting back their production, the US frackers say, thank you very much. We're all going to make a lot of money. What's happened is that the monopoly, the control that OPEC has exercised since 1973 until maybe late 2014 has probably now gone away. And again, we will start to see how that impacts the prices going further. Of course, in the last, let's say 15 months now, the price has fallen. June 2014, we saw $115 in Brent. It was about $45 the middle of January this year, and it is now just hovering around $50. Yes, a lot of the US frackers weren't hedged. A lot of them, their funding redeterminations will limit the amount of resources they've got. We will all know that the oil and gas majors are cutting back enormously on their new production activities. I received an email earlier on today, not an email that's addressed to me because I can't do anything about this, but it's an email from a recruitment company that says there's 200,000 jobs gone in the oil and gas industry in the last 12 months. That's quite a big change. Reassuring for the people who are in the oil and gas companies to one extent is a lot of those have gone in the oil field service side, Schlumberger, Halliburton, so on and so on and so on. But obviously it's an indication of a lot less activity going on in the development of production capabilities and production capacity. But it does also mention, and certainly I think one of my previous employers, Shell, I think comes top as the number of people that they've announced that they will lay off in this latest price adjustment in the market. Thermal coal price. I'm in no way an expert on coal, but I thought I would put it in there because, again, it's a fuel that used to go into the IPPs. You can burn coal or oil to produce power. What's interesting about this chart is the later period, we're seeing a fall, and some of this does reflect the same shape as we've seen in the oil. But coal is falling more because actually there aren't many parts of the world that really wants to use lots and lots of coal for lots and lots of power generation. Maybe we will find a time when we can capture the carbon. And I know there's a lot of work going on there still, but it's very expensive. If we do, then coal will become a valuable commodity again, if we can capture that carbon. I don't know the statistics, but I do know that China was originally building an enormous number of coal-fired power plants. It wasn't until they realized air quality was a problem as well that they've started to switch away from that. And I'm looking down at the UK natural gas price curve, NBP National Balancing Point. It's a virtual rather than a real hub in the UK, the NBP. One of the things I've done here, and I've done it deliberately with the gas and the power prices, I've looked at a 1 year ahead price as opposed to the daily or month ahead price. If you go into slightly more granular periods for gas and power, you see all the seasonal volatility in the numbers. And I wanted to give you a chart that the seasonal volatility is stripped out because the assumption in the market is, next year's price, we've got January, February, March, we've got spring, we've got summer. It's all rolled in together and it's all averaged out. We know that. So this is a 1 year ahead price. Again, a similar sort of pattern. What, again, you maybe is worth commenting on is at the beginning of this period, through to late 1999, you see the UK NBP year ahead. I'm going to say that's somewhere between 12 and 15 pence per therm. And then it jumps up. And actually that jump relative to the big peaks looks very, very small. But that was a jump of, let's say, 80% in the pricing. And that jump came about when the UK's interconnector went live between, I forget now, Bacton and Zeebrugge, East Anglia and Belgium, connected the continent to the UK. Prior to that, the UK's gas market, it was local gas only, plenty of production in the North Sea, it can't go anywhere else. And so the UK had a surplus and a very low price. The interconnector was built to export that surplus. But when you connect markets together in sufficient capacity, you're also influenced by the pricing on the other side of that market. The next thing to know is the European gas and power markets, they probably only started developing about 2000, 2001. European Union told all of the member states that they should be developing free markets in gas and power. You can take your view whether that really is yet arrived. There's still not a lot of liquidity in some of those markets, but there are some of the markets that are quite enthusiastic and so on. What you see, and I should say as well, is that the European gas price is an oil index gas price. It's driven by a formula that ties it to crude oil and fuel oil. And so it's no surprise to me, and it shouldn't be a surprise, that the UK NBP reflects again the oil price, because That's how the markets are tied together. I'm trying to remember whether there's something else about this one as well. But no, I think that's fine. Oil, coal, gas, they're the inputs into the projects. That's the cost side. If it's a power project, obviously the electricity that you're selling is the output side of it. It's the revenue coming in. It's where the money comes from to repay the debt, the equity returns, and so on. This chart, now this is the UK power, the GTMA Grid Trade Master Agreement, which is used in the UK, and I think was introduced about 2000 into the UK markets. And again, there's two lines on this chart, and the red line is the base power price. So that's the power price for every 24 hours, 7 days a week. And the grey one is the peak power price, which of course is itself an element of the base price. And the peak are the 5 or 12 hours a day, 5 working days of the week. So obviously a little bit less than half of the total in terms of hours. And again, these are year ahead prices, so you don't see the extremes that you would see if you are looking at day ahead, or even more so hour by hour prices for the for the gas and power that can happen, particularly where there's disruptions to the market, there's weather events, and so on. Why I chose to put this slide up particularly is that in the first period, so we're starting from February 2001, and you see the base power line, and remembering again, this is a year ahead, we're seeing it dipping below £20 a megawatt hour. And we're seeing the peak one also coming down quite closely. And this is politics. In 1997, the UK elected a Labour government. The Labour government, among other things, said that the power prices that existed prior to that were too high. So they were going to change the rules, allow more competition in the markets, and that they said that the power prices would fall by 20%. I think actually they fell by 40%. And what's interesting about this first period is that I think it was actually second half of the year of 2003, British Energy, the UK's nuclear generator, which had been privatised, I think, 1996, 1997, British Energy had to go to the UK government to be rescued from bankruptcy because the nuclear generator couldn't survive at the power prices that existed as a result of the government's adjustment to the UK power market. A year prior to British Energy defaulting, I think it was November 2002, TXU Europe went into bankruptcy. TXU Europe, of course, was a corporate, was in the supply side of the business, and so on, but was also heavily connected and an off-taker from a lot of the independent power projects. As a result of TXU Europe defaulting, and I think as a result, as a result of TXU Europe defaulting, certainly some of the independent power projects defaulted as well. Those project finance entities, they took their keys, they gave them back to the banks and said, okay, you run it. As well as that, there were some other power projects in the market at that time that were merchant finance. There were merchant plants. And it was quite odd. I was CFO of an energy company, 99, 2000. And it wasn't every week, but it was pretty close to every week. A bank would come and see me and say, look, we've got a lot of money if you want to build a gas-fired power plant. And I always thought, well, haven't you heard about NETA, the new electricity trading arrangements that's intended to reduce the price of power, therefore reduce the revenues that you're going to get? And they said, oh, it's all right. Gas price will fall and the power price, it might fall, as the government said, but there's still going to be a margin there. I actually resisted the urge because it wouldn't have been fair, and of course my company would have had to put our own equity up as well. But a lot of other people went for those types of deals. And I'm just going to flick back to the other slide as well. So here I've got the UK power price falling down below £20 a megawatt hour. And you've got to adjust, obviously, the gas price is where it's jumped up. And this is pence per therm, and I'm not going to bother to adjust therms and megawatt hours, but some people do. But what was happening there were people were looking at the early part where the gas was relatively cheap, but actually when they got there and the projects were live, the gas price had got an awful lot more expensive, the power price had fallen, and a lot of those projects, they completed construction and they ran for a little bit of a time. I think that's maybe all I want to do. I've got Netherlands prices follow a similar sort of pattern. Power prices, German power. The one slide I've not got, which is where I did want to end, but unfortunately I couldn't get this slide. North American gas, Henry Hub is the main natural gas pricing mechanism in the US. When the gas frackers got going and realized that they could produce gas very, very cheaply in the US, they actually, again, were working into a market where the price per million British thermal units of gas in the US was about $12. By the time they'd realized, and I should say is that most of the gas and power or gas producers around the world were planning on lots of LNG exports into the US markets. Somebody mentioned stranded assets, I think, earlier on today. Some of the stranded assets of the LNG facilities that the US had built in the 80s were thought to be going to come back on stream again. People were going to light these up. They would be importing LNG into the US. But at $12 an MMBTU, there were obviously also the E&P guys were also out saying, could we produce any gas locally? And they've done it wonderfully. And so $12 fell to $4, $3. I think it's somewhere between $2 and $3 at the present time. And it's maybe a little footnote, and it's not really about project finance, but actually you can pick out the project finance entities in there as well. TXU Corporation. Now, I mentioned earlier TXU Europe going bankrupt in 2002. The parent entity went into bankruptcy with the fall in the US gas prices, 2009, 2010. I forget the exact vintage where they defaulted. But it wrapped it all around. And my last of the three bullets was, is this different this time, isn't it? I just caution people. I know that over my career, and actually it was very kind of Michael to say 30 years, and that's probably true in one sense. But actually my personal calendar says I've now been working 40 years. I can mark an awful lot of highlights of my career as what's been going on in the oil markets. there's a lot of the things that surprise us. And I know if I look at that 20-year chart I showed at the beginning, I know most of the people in the oil market, the gas market, the power market, they didn't know what was coming next. And I think that's the big issue for any project finance with exposure to the commodities, is make sure you're robust to what comes next. You know, we don't plan projects for 2 or 3 years. We plan them for, as I've said, 15, 20 years and so on. And there's always a lot of surprises, so there's a lot of work around there. So anyway, enough. Any questions? Anybody want to ask me where the oil price will be next year? And I give you my honest answer. Your guess is as good as mine. Okay, thank you, everybody.